Ever wondered why some people find accounting so intimidating? Could it be due to common misconceptions? If you've ever thought that accounting is exclusively for mathematicians, we're here to tell you that's not the case. Sure, numbers play a significant role, but accounting is not all about complex calculations. It's about understanding the financial state of a business, making sense out of those numbers and using them to make informed decisions. So, whether you're a math whiz or not, if you've got a knack for problem solving and a keen eye for detail, you can excel in accounting. Speaking of numbers, another common myth is that accounting is all about digits. While it's true that numbers form the basis of accounting, it's not the whole picture. Accounting is also about interpreting what these numbers mean for a business. It's about drawing insights and making strategic decisions based on these interpretations. So, it's safe to say that accounting is as much about understanding business operations as it is about numbers. Another misconception that often clouds people's understanding of accounting is that it's solely about tax preparation. While tax accounting is a crucial aspect, it's just one of the many facets of this diverse field. Accounting encompasses a broad range of activities, from financial reporting and auditing to budgeting and financial planning. Finally, let's address the elephant in the room, the notion that accounting is boring. This couldn't be further from the truth. Accounting is a dynamic field that demands constant learning and adaptability. It's about solving real-world problems, strategizing for the future, and helping businesses thrive. If that doesn't sound exciting, we don't know what does. Now that we've busted some myths about accounting, let's delve deeper into what it truly entails. Consider accounting as the language of business, a tool that communicates the financial health of a business. But what does that really mean? Let's break it down. At its core, accounting is the systematic recording, reporting, and analysis of financial transactions of a business. It's like a ledger, keeping track of all the ins and outs, the debits and credits. But it doesn't stop there. It's not just a static record. It's a dynamic tool that helps business owners make informed decisions. So, why is accounting important? Well, it's simple. Accounting provides a clear picture of a business's financial health. It's like a barometer, measuring the financial pressure, so to speak. It tells you if your business is in the black, turning a profit, or in the red, operating at a loss. It allows you to spot trends, identify potential issues, and make strategic decisions. Remember, accounting is not just about recording financial transactions. It's also about interpreting, classifying, analyzing, reporting, and summarizing financial data. It's about understanding the story behind the numbers, the narrative that they're trying to tell. It's like being a financial detective, piecing together the clues to solve the mystery of your business's financial performance. But it's not just for the owners. Accounting also communicates to external stakeholders like investors, creditors, and regulators. It provides them with a snapshot of the business's financial position, its profitability, and cash flows. It helps them assess the financial risk and return associated with the business. All in all, accounting is a crucial tool for any business. It's not just about crunching numbers or filling out tax forms. It's about understanding the financial implications of business decisions. It's about planning for the future, managing risks, and driving sustainable growth. So the next time you think of accounting, don't just think of it as a bunch of numbers on a page. Think of it as the language that communicates the financial story of a business. Indeed, accounting is much more than numbers. It's the heartbeat of the business. At the core of accounting lies a simple equation: assets = liabilities plus equity. This is the fundamental accounting equation. Let's delve a little deeper into this equation, shall we? On one side of the equation we have assets. These are the resources owned by a business. They can be tangible, like buildings, machinery, or cash in the bank. But they can also be intangible, such as patents, copyrights, or even a company's good reputation. On the other side of the equation, we have liabilities and equity. Liabilities are what a business owes to others. This could be a bank loan that needs to be repaid, salaries owed to employees, or bills that need to be settled with suppliers. Equity, sometimes referred to as owner's equity or shareholder's equity, represents the value that would be left for the owners of the business after all liabilities have been paid off. This is often considered the net assets of a business. If you were to sell off all the assets and pay off all the liabilities, whatever is left would be the equity. Now, what's so special about this equation is that it must always balance. The total value of the assets must always equal the total of the liabilities and equity. This isn't just a mathematical coincidence, It's a reflection of the fact that all of a company's assets are financed either by borrowing, liabilities, or by the owners, equity. Understanding this fundamental equation is crucial to accounting because it provides a snapshot of a company's financial health. It tells you what a business owns, what it owes, and what is left for the owners. This balance is the foundation of double-entry bookkeeping, a system where every financial transaction affects at least two accounts, ensuring that the accounting equation remains balanced. So, whether you're a business owner trying to understand your company's finances or a student studying accounting, the fundamental accounting equation is a key concept to grasp. Remember, the balance in the fundamental accounting equation is the foundation of double-entry bookkeeping. In the realm of accounting, debits and credits rule, but what do they really mean? Let's dive right in. Debits and credits are the fundamental building blocks of accounting. They're used to record business transactions and maintain balance within the books. So how do they work? Well, it's all about balance. Debits increase the left side of an account's balance, while credits increase the right side. But hold on, let's not get lost in the jargon. Think of it this way. Debits and credits are like a seesaw. One side goes up, the other must go down. They're opposite forces, yet they work together to keep everything in equilibrium. Now, how do these connect with the fundamental accounting equation? Remember that equation we talked about? Assets equal liabilities plus owner's equity. When a business transaction occurs, it affects at least two accounts. For instance, buying equipment for your business impacts your assets and your liabilities or owner's equity. You debit the asset account for the equipment to increase it, and you credit the liability or owner's equity account to increase it. The equation remains balanced. But debits and credits do more than just keep the books balanced. They also provide a clear record of each transaction. This way you can look back and see exactly where your money came from and where it went. It's like a roadmap to your financial past, helping you make more informed decisions for your financial future. In essence, debits and credits are the language of the accounting world. They may seem complex at first, but once you grasp their purpose and how they work, they become second nature. They're the tools that allow us to record, analyze, and communicate financial information in a systematic way. So next time you come across these terms, remember the seesaw. Debits and credits, once understood, make accounting a much less daunting subject. They're not just abstract concepts, but essential tools for understanding and managing your finances. Debits and credits, once understood, make accounting a much less daunting subject. So, what have we learned about accounting today? We began our journey by debunking common misconceptions about accounting. It's not just about numbers and calculations, nor is it exclusive to those who are mathematically inclined. Accounting is a universal language that speaks volumes about a business's health and performance. It's essential for everyone involved in a business, from the top executives to the entry-level employees, to have a basic understanding of this language. We then delved into why accounting is often referred to as the language of business. Just as a language helps us communicate and understand each other, accounting helps us communicate and understand the financial aspects of a business. It allows us to make sense of the numbers, to assess the financial health of a business, and to make informed decisions. We learned that accounting is not just about recording financial transactions, but interpreting, classifying, analyzing, reporting, and summarizing financial information. Next, we introduced the fundamental accounting equation: assets equal liabilities plus owner's equity. This equation is the bedrock of accounting. It provides a snapshot of what a business owns, assets, what it owes, liabilities, and the net worth of the business, owner's equity. This equation must always balance, and it forms the basis of the balance sheet, one of the key financial statements in accounting. We also explored the concept of debits and credits, the building blocks of accounting. Debits and credits are the system that accountants use to record transactions and keep the accounting equation in balance. We learned that a debit increases an asset or an expense account and decreases a liability or equity account. Conversely, a credit increases a liability or equity account and decreases an asset or an expense account. Accounting, far from being just a numbers game, is a vital tool for understanding and steering a business. So next time you hear accounting, think language of business.